Hello, guys. Welcome to AMY Consulting. My today's topic is corporate tax in UAE. In this topic, I will explain in details about what is corporate tax in UAE, what are corporate tax registration and filing deadlines, how it's calculated, its threshold, and many others. So, let's start. Introduction to corporate tax in the UAE. Corporate tax is a form of direct taxation on the net profits of businesses, implemented to promote transparency and global competitiveness in the UAE's financial landscape. Introduced on the 1st of June 2023, this new regime is part of the government's efforts to diversify revenue streams beyond oil and gas, aligning the UAE with international tax standards while maintaining its business-friendly environment. Corporate tax registration and filing deadlines. Corporate tax registration is mandatory for businesses with taxable profits exceeding 375,000 Emirati dirhams. The Federal Tax Authority, FTA, has set clear deadlines for registration and filing based on the financial year-end. For instance, businesses with a financial year ending on June 30th, 2024 must register by June 30th, 2024 and file their returns by March 31st, 2025. Other deadlines vary accordingly for businesses ending their financial year in September, December, and March. Staying compliant with these deadlines is crucial to avoid fines and penalties. Corporate tax calculation and thresholds. Corporate tax is calculated based on a company's net profit. If a business's taxable income exceeds 375,000 Emirati dirhams, they must pay 9% tax on the amount exceeding this threshold. For profits below this figure, a 0% tax rate applies. Free zone businesses, if they meet the criteria as qualifying free zone persons, can also benefit from the 0% tax rate on qualifying activities. However, transactions with the mainland may incur tax depending on the nature of the business. Taxable versus exempt entities. Entities in the UAE subject to corporate tax include businesses operating in mainland UAE, as well as non-resident businesses earning UAE-sourced income. Free zone businesses supplying goods or services to mainland entities must also register unless exempt. On the other hand, government entities, pension funds, and qualifying free zone persons enjoy exemptions from corporate tax. To maintain free zone status, businesses must adhere to specific rules and avoid significant mainland transactions. Corporate tax implications for free zones. Free zones play a unique role in the UAE's corporate tax structure. Transactions between free zones are generally exempt from tax, provided both entities qualify as free zone persons. However, when goods or services are supplied from a free zone to the mainland, they may become taxable unless the transaction qualifies for an exemption. Likewise, mainland companies supplying goods to a free zone are subject to corporate tax. The FTA's recent clarifications have also addressed the tax periods for newly established companies, particularly those with financial years between 6 and 18 months. The consequences of non-compliance. Non-compliance with corporate tax regulations can lead to hefty fines and penalties. Businesses failing to register face an initial fine of 10,000 Emirati dirhams, with repeat offenses leading to fines as high as 20,000 Emirati dirhams. Late filing of tax returns incurs a fine of 1,000 Emirati dirhams for first-time offenses, with additional penalties for repeated delays. If businesses fail to pay their tax obligations, they may also face interest charges on overdue balances, which could significantly increase their financial burden. How AMY Consulting can assist you. At AMY Consulting, we offer expert assistance in navigating the complexities of corporate tax registration and filing. Our team ensures that your business complies with all FTA regulations, helping you meet filing deadlines and avoid penalties. We provide accurate tax calculations and offer strategic advice to optimize your corporate tax strategy, allowing you to focus on growing your business. So thank you for your time. Goodbye.